Banks are struggling to meet growing institutional demand for Bitcoin due to restrictive capital requirements that make holding the cryptocurrency on balance sheets economically unviable. Despite rising interest in digital assets, current Basel Committee rules are pushing banks to the sidelines of a market they say they are eager to enter, according to a report by The Banker. Arnab Sen, CEO of GFOX, a UK-based digital asset derivatives exchange, warned that regulatory constraints are preventing traditional financial institutions from participating in crypto markets. Speaking at the Financial Times Digital Assets Summit in London, Sen said, "The market is crying out for banks to intermediate Bitcoin trading and collateral services, but the existing rules make it almost impossible." Basel rules treat Bitcoin as high-risk asset. At the heart of the issue is the Basel framework, which assigns a 1,250% risk weight to unhedged crypto holdings such as Bitcoin, essentially treating the asset as highly speculative. This classification significantly increases the amount of capital banks must hold to support such exposures, rendering the business case unattractive. "These rules are freezing banks out of the space," Sen said in an interview with The Banker. "There's strong demand from institutional clients, but it's just not viable for banks under current regulations." This regulatory bottleneck is driving trading activity toward unregulated platforms or non-bank intermediaries, raising concerns about market oversight and systemic risk. Sen noted that conversations are already underway among global regulators to revisit the treatment of Bitcoin under Basel rules. He expressed optimism that changes could be on the horizon. "I believe the Basel approach will be reviewed this year," he said during a panel discussion on institutional crypto adoption. He described the repeal as the first step toward broader institutional participation. "The next intellectual step," Sen said, "is to rethink how Bitcoin is treated on bank balance sheets." According to a recent survey by Coinbase and EY Parthenon, 86% of institutional investors surveyed said they had exposure to digital assets or plan to make allocations to cryptocurrencies in 2025. Besides, thanks to the evolving regulatory landscape worldwide, institutions are increasingly viewing cryptocurrencies as a legitimate component of a balanced investment strategy. Gadi Chait, investment manager at Xapo Bank, said in a recent interview that historically, institutional investors have been deterred by several factors, particularly crypto volatility concerns. However, he added that with more awareness and research, investors are understanding the varying degrees of risk and utility.